recipes for technical trading success in Cook's Kitchen.
Are you ready to talk about the R word? Of course, I'm talking about recession. Now, why would we want to talk about recession? We just got through the midterms. We've had not one, but two corrections this year, both 11%. And we're in the seasonal sweet spot, right? The market should just keep rallying from here. And it may, but we've been talking about the growth peak. And Morgan Stanley, Mike Wilson at Morgan Stanley has been all over this, the economics and the earnings of it. And I have some charts that you need to see because fund managers are looking at this data and trying to think out a quarter, 2 quarters, 3 quarters, because they can't wait until a recession sneaks up on them. All right, so let's go to the charts. First off, I'm going back to October 29th on my screen here. This was part of my taser commentary, reviewing, once again, Morgan Stanley, King of the Bears, Mike Wilson's strategy team. This is not actually economic data. This is a chart of market breadth confirming what they've been talking about all year, that market breadth is breaking down. And they use the NYSE data here, only 40% of stocks above the 200-day moving average. And they have all these reasons that, we've seen this movie before, right? During other crises and recession. And right now they're wondering, are we having a liquidity crisis and an earnings recession? Okay, next chart is from Goldman Sachs. This is the S&P pricing in a sharp slowdown in the ISM index. So the stock market, the S&P is the dark blue line. The dark blue line is the ISM. The S&P is the light blue line. And so look how closely they track each other, generally over time. Obviously, ISM is indicative of GDP. What's happening here? The light blue line, the ISM, or rather, I keep mixing this up. The light blue line is the S&P. It is falling. And what is it telling you about potential future changes in the ISM? Okay, so I messed that up a few times, but you get the idea. S&P is going down while ISM is up near 60. What does that mean? Does it mean that the ISM is going to soon plunge? Or does it mean the stock market is overreacting? David Kosset at Goldman Sachs, at the time he said, stock market's overreacting, even though the Morgan Stanley team would say, no, that's where we're headed. So that's the debate. Now, let's go to 3 important charts that will update us on this, this dilemma. All right, first off, I found this on Vetter. Ned Davis has a global recession probability model. Every investment bank, every fund manager has their own probability model, whether it's intuitive or extremely quantitative. Ned Davis has a very quantitative one. Let me see if this is the best look at it here. Oh, no, it looks better in white. Okay, so their data goes back to 1970 or earlier. And high recession risk up here, obviously low recession risk down here. Where are we now? We are above 70. And 70 is when they start to get worried. Look at the data. This is sort of a table that summarizes the data. Since 1970, 92% of the time when a reading is above 70, we had a recession. Only less than 8% of the time it did not result in a recession. So this is a pretty decent model from Ned Davis. And I think that this came out in middle of October. And I'm just finding it now. It's amazing what you can find on the internet. And I think it's something we need to pay attention to because their model has been extremely accurate. Not like, 9 of the, 9 of the last 5 recessions were predicted, by a correction. I forget how that goes. But anyway, the market is telling you that investors are nervous, but here's a quantitative model, and I obviously don't know all their inputs. Let's go to their next chart. Oh wait, I forgot one thing I got to show you. Leading up to this, let's look at some more data. We got to look at this from Barclays. So this is the global picture. So we've gone from the narrative of a global synchronized recovery of the past 2 years to now a global synchronized slowdown. So Barclays looked at the data, looked at ISM and PMI data from around the globe. So we'll look at the chart on the left first. Global manufacturing, new orders plummet on trade wars. And so the dark blue line is global manufacturing confidence, and the blue line is new orders less final goods inventories. Okay, plunging here. All right, let's go to the chart on the right and get to see let's get to see it by region. Obviously, China, emerging markets, and the euro are, they've seen slowing growth. We've seen China's stock market plummet. Here is the dark blue here is the U.S. This is new orders. And we just saw the ISM miss, right, this week. It was supposed to come in at 59, really strong, right? Came in just above 57. Not a big deal, still expansion territory. But if you look at the new orders component of the ISM manufacturing, it peaked in December of last year at 67 and has now come down to 57. So that new orders has fallen rapidly, and is it a precursor of the ISM falling to 52? Which is, the chart from Goldman Sachs implied that, hey, the stock market is acting like the ISM is going to fall out of bed here down to the low 50s. All right, so back to Ned Davis now. Another part of their model comes from, they have a bear watch indicator where they're just looking at, obviously what's happening in stocks. And this has reached 40, which is a critical level for them. In the past, when it's blown through 40, look at the corrections we've had. 1998, 23.8%. This is global stocks. Obviously, 2002 to 2000 to 2002, big corrections there. Clearly, 2008 was huge. So they're up against this 40 level, and they're getting concerned. It hasn't flipped yet. Like one more piece of data would flip this for them. So again, this is what large fund managers are looking at because they need time to get out of the market if they really perceive a recession's coming. And they're getting all the signals around the world, looking at economic data like the ISM and the PMIs, and you're seeing it show up in our stock market. So I'm not saying that the Q4 rally is off the table. We could still make new highs. But there is this building caution, and Morgan Stanley has been all over it all year, and they've been right. And now others are looking at it, especially based on this Ned Davis research. So, global synchronized slowdown is here. Does it lead to a recession in the U.S.? It's hard to say. Nobody has the perfect crystal ball. Ned Davis has got a pretty good one, and theirs is screaming, hey, a recession is coming. Now, if that doesn't show up in the data for another 3 to 6 months, then maybe the market is sanguine and we continue to drift higher. But you're going to see, I think, some fund managers lightening up their books and anticipating the possibility of rising rates giving us, stronger dollar, and we see that global slowdown spill over onto our shores. All right, so that's my recession watch. We'll see you next week.